Gold is trading around $5,400 as I record this. Silver is pushing 96. Both are breaking out, both are surging, both are ripping through resistance levels that have capped price for weeks. And by the time you're watching this, gold may have already cleared 5,400 and be moving straight toward the all-time high near 5,600. At the end of this video, I'm going to explain why 5,400 was the final line in the sand for sellers, the last level holding this market down, and why, once that level gives way, the path to 5,600 and potentially far beyond opens up with very little standing in the way. But first, we need to talk about what happened in the last 24 hours. The footage coming out of the Middle East is unlike anything I've seen in my lifetime covering markets, and every second of it is pouring fuel on this gold and silver breakout. Before anything else, I want you to picture this. The night sky lit up. Multiple streaks descending at incredible speed. People on the ground shouting as they watch it unfold, knowing there is nothing they can do. What you're seeing in moments like that is not just another headline. It's advanced missile technology being used in active conflict, including hypersonic systems capable of traveling at extreme speeds and maneuvering mid-flight. Unlike traditional ballistic missiles that follow predictable arcs, these next-generation systems can alter their trajectory, making interception dramatically more difficult. Modern defense systems are built on prediction, calculating where a missile will be and placing an interceptor in its path. But when an object is traveling at many times the speed of sound and changing direction along the way, the margin for error shrinks to almost nothing. The math becomes far more complex. The window to respond nearly disappears. And here's why markets care. When long-standing assumptions about global security are challenged in real time, risk models change instantly. Institutional investors price assets based on probabilities. Probabilities of containment, deterrence, stability. When those probabilities shift, capital moves. That's what you're seeing in gold right now. Safe haven assets don't just tick up a few percentage points when foundational assumptions break. They reprice. Entirely. And it's not just about one system or one event. Reports of missile strikes near major population centers, attacks on strategic facilities, and rising direct tensions between regional powers and the United States have dramatically escalated the perceived risk environment. When escalation moves from rhetoric to action, markets respond fast. Add to that the economic asymmetry of modern conflict, where relatively low-cost offensive systems can threaten extremely high-value defensive assets, and you create a risk equation that investors cannot ignore. Uncertainty expands, hedging demand rises, gold becomes insurance again. That's why 5,400 matters. For weeks, that level represented heavy resistance, the final defense for sellers betting this rally would fail. But when geopolitical risk intensifies this quickly, technical barriers weaken. If 5,400 decisively breaks, the next major magnet is the previous all-time high near 5,600, and above that, price discovery begins. Now let me say something clearly. Real people are being affected by these events. Lives are at risk. Families are living with fear. I cover gold and silver. That's the focus of this channel. But none of this is something to celebrate. Rising metal prices driven by instability are a symptom of a world under stress. My goal isn't to sensationalize conflict. It's to help you understand how global events connect to your savings, your purchasing power, and your financial security, so you can make informed decisions in uncertain times. This is the hidden economy, where we connect the dots the mainstream often leaves unconnected. If you care about protecting what you've built, about understanding how global risk translates into market movement, and about staying ahead of these shifts, make sure you're subscribed. This situation is escalating by the hour. If you believe more people need to understand what's happening, share this video. Push it out. Because what I'm about to lay out isn't one isolated event. It's a chain reaction. Every move triggered the next. And by the end, you'll understand why this breakout in gold has momentum unlike any rally we've seen in recent years. Let's walk through it step by step. After the reported killing of Iran's supreme leader, expectations in Washington and Tel Aviv were clear. Iran would fracture. The regime would destabilize. Internal unrest would explode. Chaos would follow, and eventually surrender. That's not what happened. Within hours, Iran announced an interim successor. The command structure didn't collapse. It reorganized. The military didn't retreat. It escalated. And instead of mass uprisings against the government, large crowds gathered in mourning and anger, demanding retaliation. What followed caught nearly everyone off guard. The hypersonic missile strike that evaded multiple interception attempts wasn't just a random battlefield event. It looked calculated, strategic, a message, a demonstration of capability under real-world conditions. When advanced missile systems are challenged publicly and appear vulnerable, that footage doesn't just circulate online. It circulates through defense departments, intelligence agencies, and financial institutions worldwide. Every strategist watching asks the same question. What does this mean for deterrence? And deterrence is everything in risk modeling. Modern defense systems are built on predictive interception, calculating trajectory and response timing. Hypersonic glide vehicles, which can maneuver mid-flight at extreme speeds, compress reaction windows dramatically. Even small decreases in warning time change outcomes, now expand that concern beyond a single region. Reports have highlighted vulnerabilities in missile defense coverage, including the threat of anti-ship hypersonic weapons. When major naval assets operate within range of evolving missile technology, that changes the perceived risk landscape overnight, and markets react to perceived risk, not press conferences. Then the focus shifted to one of the most critical economic choke points on Earth, the Strait of Hormuz. Roughly 20–30% of the world's oil supply passes through that narrow corridor every single day. Any disruption there immediately reverberates through global energy markets. Reports of tanker strikes, restricted ship movements, and rising tensions in and around the strait sent a clear signal. Energy flows are no longer guaranteed. When a choke point becomes unstable, there are no easy workarounds. Oil either moves or it doesn't. Analysts, including those at S&P Global, have warned that sustained disruption could send oil sharply higher. And higher oil doesn't just mean higher fuel prices. It feeds into transportation, food, manufacturing, aviation, nearly every sector. The inflation pressures central banks have been fighting suddenly gain reinforcement, and that alone could justify gold breaking out. But it didn't stop there. Iran reportedly struck a major U.S. early warning radar installation in Qatar, a system designed to detect missile launches thousands of kilometers away. What shocked analysts wasn't just the strike itself, it was the cost asymmetry. A relatively inexpensive drone reportedly disabled equipment valued in the billions. That kind of cost imbalance reshapes strategic calculations. When lower-cost offensive systems can neutralize extremely high-value defensive assets, the economics of modern warfare shift dramatically. Investors understand this. Then the instability spreads socially. The U.S. consulate in Karachi, Pakistan, was attacked by a large crowd amid rising anger over regional events. Windows were broken, fires were set. Security forces struggled to regain control. When unrest spills beyond governments and into civilian populations across multiple countries, predictability evaporates, and unpredictability is rocket fuel for safe haven demand. Gold thrives not just on conflict, but on uncertainty about the scope of conflict. This is no longer a localized flare-up. It's evolving into a multi-layered crisis, military, economic, political, and social, all at once. Now connect this back to the chart. Gold breaking 5,400 isn't just a technical breakout. It's a repricing of global risk. It's institutions recalculating worst-case scenarios in real time. It's capital moving into assets that have survived every geopolitical shock in modern history. Silver is following, because when monetary fear rises, precious metals move together. This rally has legs because it isn't built on speculation alone. It's built on structural uncertainty, energy risk, defense risk, escalation risk, inflation risk. And those risks don't disappear overnight. This is the hidden economy, the layer beneath headlines where capital actually shifts. If you care about protecting your purchasing power, understanding how global instability translates into asset prices, and staying ahead of these moves instead of reacting late, stay with me. They initially hoped it would be a protest that burned itself out, but when the crowd forced its way inside, when fires began spreading through parts of the compound, American security personnel opened fire. According to reports from Al Jazeera, several Pakistani protesters were killed. That moment matters. American security forces firing on civilians on Pakistani soil, in an already fragile relationship between two nuclear-armed nations, is not a small development. Images like that don't stay local. They move across social media in minutes. They reshape public sentiment. They create pressure on governments that were not planning to escalate. Now think about the broader context. The same week Washington reaffirmed support for Pakistan's security operations. The same week diplomatic praise was exchanged publicly. And now this. The contradictions are staggering. And when contradictions pile up in geopolitics, stability erodes fast. This is what makes the situation so complex. Missiles can be intercepted, infrastructure can be rebuilt, but ideas, narratives, grievances, those spread in ways no defense system can stop. When a conflict shifts from a conventional military confrontation to something ideological and decentralized, the risk profile changes completely. You can deploy aircraft carriers against a state. You cannot deploy them against global unrest fueled by belief. And every time unrest spills into another country, every time another diplomatic post is threatened, every time a new front opens in a place that wasn't on anyone's radar, gold and silver respond. Because markets do what they always do when risk becomes impossible to quantify, they seek assets without counterparty exposure, tangible assets, metal. So let's step back and recap the full picture. Gold is testing 5,400. Silver is pressing near 96. Advanced missile systems have challenged modern interception capabilities. Jerusalem has faced ballistic strikes. A U.S. weapons depot in Iraq has reportedly been hit. A major early warning radar installation in Qatar was disabled by a low-cost drone. The Strait of Hormuz is under strain, threatening global oil flow. Energy prices are rising. Regional tensions are escalating. Diplomatic facilities have been attacked. Leadership transitions in Iran happened rapidly, signaling continuity rather than collapse. That is not a short-term headline cycle. That is structural instability, and all of it is feeding directly into the metals market. Now let's talk mechanics. Because this breakout is not random, it's structural. For weeks, 5,400 has acted as major resistance in gold. Each time price approached it, selling pressure emerged. Institutional short positions increased. Futures contracts were used to suppress upward momentum. And each time, buyers absorbed that supply. What we're seeing now is pressure building at that ceiling. When a level is tested repeatedly and sellers fail to push price meaningfully lower, something changes. Shorts who entered at resistance begin to feel pressure. As price pushes through, those short positions move underwater. To limit losses, they must buy back their contracts. That buying drives price higher, which forces more shorts to cover. That's the squeeze dynamic. Silver is even more sensitive. The global above-ground silver market is tiny relative to other asset classes. It doesn't take trillions to move it. Concentrated flows can move it dramatically. And right now, demand is coming from multiple angles. Safe haven interest, industrial demand from solar and defense sectors, retail accumulation, and strong physical premiums in Asian markets. When there's a divergence between physical pricing in the East and paper pricing in Western futures exchanges, tension builds. That tension eventually resolves. And when it does, silver doesn't move in small increments. It reprices aggressively. Now, why does 5,400 in gold matter so much? Because it wasn't just a psychological round number. It represented a rare technical convergence. Long-term moving averages, previous rejection highs, and volatility bands all stacked in the same zone. When multiple technical indicators align, they create what traders view as a wall. And that wall held multiple times. Each rally attempt was pushed back using the standard playbook: paper selling, futures pressure, added short exposure, strategies that have worked for decades. But this time, the force pressing against that wall is different. It isn't retail enthusiasm. It isn't short-term speculation. It's structural geopolitical risk. It's energy insecurity. It's visible cracks in defense assumptions. It's inflation pressure re-entering the system. Paper supply can cap enthusiasm. It struggles to cap fear. If 5,400 gives way decisively, the next major historical level sits near 5,600, the all-time high. And above that, there's no historical resistance, no trapped supply waiting to break even, no ceiling of past sellers. Traders call that blue sky breakout. It means price discovery. Every holder is in profit. There's no overhead inventory weighing on the market. Momentum feeds on itself. And the catalysts behind this move, geopolitical escalation, oil risk, defense vulnerabilities, inflation resurgence, are not single-day events. They are ongoing developments with uncertain timelines. When uncertainty stretches, capital migrates. Silver historically follows gold in breakouts, but with leverage. When gold moves, silver often accelerates. That's where we are right now. A technical level under pressure, against a backdrop of rising global instability. This isn't just another rally attempt. It's a market repricing risk in real time. This is the part most people miss, and it's the part where the biggest gains are made. Historically, when gold breaks to new all-time highs during a geopolitical crisis, silver doesn't just follow, it outperforms, often by 2 to 3 times. Why? Because silver lives in two worlds. It's a precious metal bought for safety when fear rises, but it's also an industrial metal consumed in the real economy, especially in sectors that accelerate during instability. Defense manufacturing, advanced electronics, energy infrastructure like solar. When oil prices spike and nations push for energy independence, silver demand increases. Here's the catch. Supply doesn't respond quickly. You can't just flip a switch and open a new silver mine. Even in stable conditions, bringing a new mine online can take close to a decade. In a period of geopolitical disruption, supply chains tighten, permitting slows, financing becomes harder, expansion effectively stalls. So demand rises, supply stays constrained. That imbalance is what creates explosive upside. If gold were to climb 20% from here, silver historically has the potential to move 40% to 60% in comparable breakout environments. At 96, that kind of move would put silver dramatically higher, and that's assuming conditions stabilize. But the developments we're watching, escalating military tension, energy choke point risks, regional spillover, suggest uncertainty is expanding, not shrinking. Let me be clear about something. I've covered gold and silver through fear spikes, financial crises, inflation scares, geopolitical flare-ups, and what we're seeing right now doesn't fit neatly into any of those categories. This doesn't look like a short-term fear trade, where price surges and then fades once headlines cool. It doesn't look like a temporary geopolitical premium that gets priced in and forgotten. What it resembles is something deeper, a structural repricing of global risk. The world before this week and the world after it may not carry the same baseline assumptions. Markets are trying to determine what the new baseline is, and that process is not finished, not even close. So what matters from here? There are three major variables I'm watching. First, the Strait of Hormuz. If that choke point experiences sustained disruption, oil prices could surge sharply. Energy feeds into everything. Transportation, food, manufacturing, heating, aviation, inflation pressures would intensify rapidly. Central banks would face a policy trap, tighten into a slowing economy, or ease into rising energy inflation. Neither choice is clean. In that kind of policy paralysis, gold historically benefits as neutral collateral. Second, U.S. naval assets in the region. If a major capital asset were severely damaged, the geopolitical escalation path changes overnight. Markets would move from pricing tension to pricing full-scale conflict risk. Central bank gold purchases, already elevated in recent years, could accelerate further under those conditions. Third, conflict spillover beyond the immediate theater. We've already seen unrest in places not traditionally considered frontline participants. When instability spreads into additional countries, especially unpredictably, markets struggle to model outcomes. An unmodeled risk is what drives the fastest repricing in safe haven assets. Now let's talk practically. If you already hold gold and silver, volatility is part of the journey. There will be sharp pullbacks. There will be rumors of de-escalation. There will be days when metals drop hard and social media declares the rally over. Short-term noise does not automatically invalidate long-term structural drivers, supply deficits, central bank accumulation, industrial demand, and geopolitical risk. If you've been on the sidelines, I won't tell you what to do. But understand this. 5,400 in gold represented major resistance. If that level decisively gives way, the next historical marker is near 5,600, the prior high. Above that, price discovery begins. Sometimes markets offer deep pullbacks before major moves. Sometimes they don't. That's the reality. Where do you think gold closes this week? Where does silver go if energy risk intensifies? Does the situation around the strait stabilize or deteriorate? Drop your thoughts below. I read them. If you're new here, go back and watch the earlier breakdowns in this series. We've discussed escalation risks, silver's structural supply issues, energy choke points, and how they interconnect. Seeing the progression helps you understand how these pieces fit together. This is the hidden economy, the layer beneath headlines where capital reallocates. Stay sharp, stay disciplined, watch the levels. 5,400 is under pressure. 5,600 is the next major test. What happens after that depends on how this global risk cycle unfolds.